Becoming your own bank through institutional-grade infinite banking. 1. Understanding the concept of infinite banking. What if you could earn 10% plus on your money while using it to buy more income-producing assets, without touching the original capital? That's what institutional-grade infinite banking does, and today I'm going to show you exactly how. You must first understand that infinite banking, when executed at an institutional level, is a process of creating and controlling your own lending capacity by using your own capital as the foundation for credit. This differs from retail-level financial products commonly sold by advisors, which often restrict growth and transparency. You achieve this by placing your capital into a financial instrument that allows it to grow while simultaneously using it as collateral for credit, enabling you to lend to yourself repeatedly. The strategic advantage is that your funds continue compounding uninterrupted while you deploy borrowed capital into cash-flowing assets. This approach eliminates reliance on traditional lenders and shifts control of liquidity and returns entirely to you. Footnote: this section introduces the principle of self-directed credit creation where your assets simultaneously grow and serve as collateral. 2. Limitations of indexed universal life policies. Many advisors promote indexed universal life (IUL) policies as tools for infinite banking. However, these instruments often carry hidden insurance costs, reducing the effective yield without the owner's full awareness. Typical IUL returns range between 4 and 6% annually and require borrowing directly from the policy, which halts the growth of the borrowed funds. This interruption in compounding undermines the leverage advantage of infinite banking. You must recognize that if borrowing from your own policy stops its growth, your ability to outpace borrowing costs and inflation is diminished. In institutional-grade strategies, uninterrupted compounding is non-negotiable. Footnote: this section explains why retail-level insurance products fail to provide uninterrupted growth necessary for efficient infinite banking. 3. Using high early cash value whole life policies. The institutional-grade solution involves a high early cash value (HECV) dividend-paying whole life policy issued by a top-rated insurance company with an A+ or higher credit rating. Such policies have operated longer than major U.S. banks and can yield 9 to 12% annually when combining guaranteed growth and tax-free dividends. By minimizing insurance costs and maximizing the proportion of contributions allocated to cash value, you position your capital to grow at institutional rates. This positions you to borrow against the policy at lower rates than your growth rate, creating a spread that produces net profit even before deploying the borrowed capital. Footnote: this section identifies the specific type of policy that enables high yield, low cost, uninterrupted compounding suitable for institutional level banking. 4. Leveraging lines of credit against your policy. After funding your HEC policy, you secure a line of credit against its cash value. Unlike IUL loans, this does not halt the policy's growth. If your policy earns 10% while you borrow at 4 to 6%, the positive spread yields profit before you invest in any asset. This method allows you to continually expand available credit as your policy's value increases, thereby compounding both the asset base and the leverage available to you. Properly managed, this spread becomes a self-reinforcing cycle of growth and liquidity. Footnote: this section details how borrowing against your policy without halting growth creates a continuous positive yield spread. 5. Deploying borrowed capital into cash-flowing assets. Once you have secured a line of credit, you deploy that capital into hard assets that generate consistent cash flow. Preferred categories include real estate and energy sector investments such as direct oil and gas production interests. These sectors offer the dual advantage of income and significant tax deductions, such as depreciation, intangible drilling costs, and depletion allowances. This cash flow services the line of credit, enabling rapid repayment and immediate redeployment of borrowed capital into new investments without selling existing assets. Footnote: this section emphasizes that cash-flowing hard assets not only repay your credit line but also provide tax-advantaged income streams. 6. Tax advantages of real estate and energy assets. When you invest in real estate, you benefit from depreciation and preferential tax treatment on passive income. In the energy sector, intangible drilling costs can offset up to 80% of your investment in the first year, while tangible drilling costs provide multi-year depreciation, and depletion allowances reduce taxable income from production. These incentives significantly lower your effective tax rate, allowing more capital to remain in compounding investments and accelerating the infinite banking cycle. Footnote: this section outlines how targeted investments in real estate and energy sectors provide compounding tax advantages that support rapid capital recycling. 7. Repetition and scaling. You repeat this process continually, expand the policy's cash value, increase the line of credit, invest in cash-flowing assets, use the income to repay the credit line, and reinvest. Over time, both your asset base and lending capacity expand exponentially. Unlike conventional investment models, you are not liquidating assets to fund new opportunities, you are using the same capital repeatedly while it grows. This is the foundation of building an institutional-grade banking model for personal wealth. Footnote: this section describes how the process of reinvesting borrowed funds while assets grow enables scalable, exponential wealth accumulation. Now you know the process the wealthy have used for decades to double-dip their returns. The only question is, are you ready to stop being just a saver and start being your own bank?